cash flow or capital growth? It's the age-old debate for property investors. And in 2025, with interest rates still high, rents surging in some markets, and others showing signs of a slowdown, the decision has never been more critical. In this video, we'll break down the pros and the cons of each strategy, look at real-world numbers, and ultimately help you decide what's right for you based on your goals, risk profile, and where we are in the market cycle. So let's start with the basics. Cash flow means your rental income minus all expenses of holding that asset. Typically, for cash flow properties, we really want to generate a lot of income from the rent, offsetting a majority of the holding costs, ideally giving you a positive monthly income. On the other hand, equity growth comes from your property's value increasing over time, sometimes without strong rental return. In 2025, the game has changed. Interest rates are still hovering around 5 to 6%. For many investors, rental yields are rising in regional and affordable metro markets, but property growth has been largely uneven. If you want your portfolio to pay you from day one, cash flow might just be the answer. So why is cash flow hot right? Rental shortages across Queensland, South Australia and Western Australia are leading to high yields in excess of 5%. Often with the high interest rate environment, there's also a serviceability crunch which we're seeing, which makes positive cash flow properties quite attractive. And more investors are chasing yield to offset the cost of living pressures. But here's the catch. Cash flow alone doesn't build wealth quickly. It helps you hold the property, but the big money comes from the equity growth over time. So then let's talk about capital growth, the long-term engine for wealth. So why does equity still matter in 2025? Well, the fact is most millionaires in property made their wealth through compounded annual growth over time. Growth opens up equity releases and future investments as well. Within many of the core markets such as Sydney, Melbourne and Brisbane, we're seeing a real bounce back with pockets showing 10 to 15% annual growth again. So let's use this as an example. If you buy a $600,000 property in Brisbane that grows at 8% per year, it could become $880,000 in 5 years. That's a $280,000 gain, or $56,000 per average every year. Now, if you compare that to $3,000 to $5,000 of net rental income, you know which strategy wins. But there's a catch. High equity growth strategies are often negatively geared in the short term, which means you are funding the gap, and that could really hurt in a high interest rate environment. So which is better? Well, the answer as always is it depends. Cash flow could be ideal if you're early in your journey and need income to hold the asset. Or perhaps you want to scale quickly and improve your borrowing power. But it could also help if you want to semi-retire and reduce your reliance on your job. However, growth could be ideal if you're young, on a strong income and can hold for the long term, or if you want to build equity to reinvest. And you can tolerate the short-term cash drain for that long-term gain. A tip in 2025, many smart investors are actually able to achieve both, securing affordable properties in high-yield areas that have long-term growth fundamentals. These hybrid plays can often offer the best of both worlds. So our investors are getting both the ability to generate that cash return as well as seeing strong growth from holding that investment. So let's talk about maybe some frameworks that you could use to help you decide. The best way is firstly to start with your goal. Are you looking for passive income in the next 3 to 5 years or long-term wealth creation? That will help you quickly delineate whether cash flow or equity growth is good for you. Secondly, you could assess your cash position and borrowing capacity. If you're very limited in cash, and your borrowing capacity is hugely constrained, then equity growth might actually limit you in that property journey. Additionally, you could look at market cycles. Right now, some growth markets have already had a hard run, whilst others are still just starting to warm up. Fourthly, you could look at the stress test of high interest rates. Could you afford another 1 to 2% interest rate increase without it breaking the bank for your family? And finally, don't just chase one. Build a portfolio that allows you to get the benefits of both over the long run, putting you ultimately in a much better position to not have to give away too much of that short-term lifestyle while still getting a lot of equity growth in that long term as well. So we like to say simply, cash flow puts food on the table, whereas growth builds the table itself. If you're stuck choosing between the two, ask yourself, which do you need most right now? Cash or capital to build that property portfolio? If this helped, please like and subscribe. I post weekly videos breaking down investment strategies, suburb insights, and tips for how you can build long-term wealth creation through property investment in Australia. Drop a comment. Are you team cash flow or do you prefer equity growth? And if you want help crafting your investment strategy tailored to you, check out the link in the description to book in a free call with us at Handle Properties, and we can chat through your situation and which one is best for you. Thank you.